The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you. Now, Small Business Tuesday continues with Your Money, Your Call.
The Reserve Bank dropped interest rates by another 0.25% today to a new historic low of 1.5%. However, the share market had fully anticipated the move and ended up down 48 points, almost a full 1% drop for the day. After starting to recover from a sloppy start at the start of the trading session after the RBA announcement, the market promptly dropped at 3 p.m. when the Commonwealth Bank stated they would only be passing on about half of the interest rate cut to their customers. And that was followed by the other banks, which cut between 10 basis points and 14 rather than the full 25. At the same time, the banks raised their deposit rates, causing investors to worry about margin pressure for the banks looking ahead. Sealing the bad day's trading was the energy sector, down over 3%, material sector down 1.2% after a weak overnight read for commodities. Good evening and welcome to Your Money, Your Call. I'm Ken Bloomfield from Financial Clarity. If you have a question about shares, our phone lines are open on 1300 30 34 35, or if you prefer, you can email us on yourmoney@skynews.com.au. Joining me on the panel tonight is Andrew Page from the Motley Fool and Carl Capolingua from Investor Systems. Welcome, gentlemen.
G'day, Ken.
Here on a big night. It's always good to be here on a Reserve Bank night, isn't it? But that was an interesting one today. What do you make of it all, Andrew? Rates going down. Obviously, market expecting that, but still the market dropped and reacted to the banks in particular.
Yeah. Well, it's interesting times we live in. We're looking at a very flat yield curve at this point in time, so there's not much expectations for those rates to go anywhere. It's interesting, if you look at it in terms of the real interest rate, inflation adjusted, we've actually seen a slight increase here. And that, of course, is, the bank's mandate is to look at inflation, and it's the low inflation that's really forcing their hand here. Yeah. Of course, some people are worried that, you use all your powder now when we actually have a real emergency. Perhaps there's not going to be enough dry powder there to use that.
It's tempting to wonder about that, though, isn't it?
It is.
If we do get a property crash, or, if we get some sort of external event from overseas, and we've already used all the powder, so to speak, it's a bit concerning.
I mean, I'd argue the Reserve Bank's getting very close to that limit already. We've already seen when they make these cuts, the banks are unable to pass the full cuts along, and they can't really, if we're being fair. I mean, they get a lot of their funding from offshore markets. The pricing there is a little bit different. Yes, they increase their interest rates to depositors, but on the products that they're talking about there, it's a relatively small proportion of their deposits as well. So I think it was more of a PR exercise than anything else there. But, so if we see the RBA continue to cut rates, when I can't for a second imagine that the banks are going to pass all of those along, just simply because they can't. But
it's just getting too skinny down there, closer to zero.
It really is. I mean, interest rates are a very powerful tool, but they're a very blunt instrument, and particularly when you get to these levels, they start to wane in their effectiveness.
Yeah. So, Carl, what do you think about today and the reaction by the market there?
Look, I think today is just another example of how crazy markets are starting to get. I mean, I've been doing this for over 2 decades, and I don't recall a time, unless you can remind me, where the banks, after an RBA cut, banks cut rates on mortgages and increase rates on deposits. I can't recall when that happened. It's almost a bizarro world sort of scenario. So it's an example of, you would have heard this term, dislocations that are occurring in the markets, not just here but all around the world. And these sorts of things don't fill me with overwhelming confidence about where the global economy is going. You're not cutting rates to record lows because things are fantastic at the moment. That's certainly not the reason why rates are very low around the world. I think the impact of low rates has been shown. I think history is beginning to show quite clearly that the positive effects are limited and are becoming more limited as time goes by. So something's got to change pretty soon. The question will be how markets deal with that. I know I'm setting up more questions than I'm answering at this point.
You're supposed to be here to answer the questions.
Well,
but no one's asked him yet, I guess, so that's all right.
Well, maybe we'll get to some questions and we'll answer a few.
Yeah. No, look, it is interesting, isn't it, gents, because, really what's happening in Australia now is what would have happened 8 years ago if we didn't have the resources boom and if we didn't have the recovery from China, because this has really happened all around the world. And so in many respects we had a playbook all around the world to see what was going to happen. So it came as no surprise to me that the banks are now starting to get some margin pressure at all, because you just have to look to either North America or Europe, and it started happening for them 7, 8, 9 years ago. So, but it does put them in a bit of a dilemma, because if the property market particularly does start slowing down a little bit, then they're chasing all the other scraps on the table. And the thing that I noticed looking at last CBA result, which I thought was a little bit alarming, was that they were really chasing a fair bit of commercial property business. And also just big commercial deals in this part of the world. And the problem now, of course, is they're competing against banks like the Bank of Japan, banks from Japan, and from Asia and from Europe, and they're all hungry to get debt, to actually finance debt around the world. And I know some of the projects that CBA took on when we were having a look at their books in the last quarterly report. I really didn't think they were great deals. They were very, very skinny margins, and so that makes it really interesting. And I guess it goes right to the heart of whether that dividend's going to be sustainable.
Yeah, look, I think the banks are phenomenal institutions. They are. They'll be around for decades to come. But I do share your caution there. I think there's a couple of things. We've got a very long experience in this country. Investors have a very long experience with the banks, and it's been overwhelmingly a fantastic experience. Yeah. And, there's a couple of reasons for that. 25 years without a recession certainly helps. But there's been some really...
Helps a lot.
Helps a huge amount. It makes us, I think, we tend to forget that these are cyclical organisations. There's nothing wrong with cyclical businesses, of course, but I think we tend to forget that. And there's also been a number of structural tailwinds that are really driving lending. I mean, that's how banks make money. That's their product. They lend money.
As interest rates keep going down and down and down, it's easier to lend more money.
And we've had that tailwind there. We've had the property boom, which is really the biggest driver that's been there as well. But also other one-off type things. We've had increasingly dual income families as well, which has increased the borrowing capacity of households as well. And these factors have all driven to have incredible earnings growth and therefore incredible dividend growth for these businesses. But we've got new capital requirements coming in. We've got it's harder to lend money to worthwhile courses, at least, and those margins are under pressure. So it's something that I'd be a little bit mindful of in assuming that things will just continue as they always have.
Yeah, indeed. Okay, thank you, gentlemen. Now we've got our first caller. We've got Luke on the line. Luke, how can we help you tonight?
Good evening, panel. I like your opinion on a couple of stocks that we've held for about 12 months. First one's Vita Group, BTG, and the second one's Hansen Technology, HSN. They've had a pretty good run of late, and just wondering whether it's time to take some money off the table or just let them ride. Thanks.
Okay, good. Thanks, Luke. Might go to you on this one first, Andrew.
Yeah, well done, Luke. You've done very well on those investments, and I think both of them are fantastic companies. I think Hansen is just a wonderful business. These guys do software for utilities, so you tend to have very, very sticky customers, wonderful recurring revenue, very capital-light model.
Yeah, it's a nice little niche, isn't it?
It's just great. It's very hard for their customers to switch, and frankly, there's not much reason for them to do so. They deliver a very good service. So I think they're great businesses. I think Vita's also a wonderful business too, with a very good record. Its price has done very well, but it's been driven by the underlying performance of the business. I know that in my experience, some of my bigger investing regrets has been looking at a performance of a share over the past year and feeling as though I've needed to take action to lock that profit in. Personally, if you are a long-term investor, I'd be in no rush to take the money off the table. These businesses, I think, will do well for a while. Hansen, in particular, we've got so much of their earnings are coming from offshore that, if Australia does get into a bit of trouble, you're going to be fairly well immunised from that, and also just the nature of the business that they have as well.
Yeah.
So I'm very positive on Hansen. I think it's a great stock. I wouldn't be selling it.
Okay, fantastic, Andrew. And Carl, what do you think for a technical perspective as well?
Yeah, look, I don't like agreeing with Andrew. I try. We do our best.
Few people do.
We do our best not to agree generally when we're on the show. But,
Well, it makes for better TV.
It does.
Yeah, unfortunately, I absolutely agree with him. They are both brilliant businesses. The businesses we've followed for a long time. They've been in just wonderful trends, and they're only in those trends because each of them have double-digit earning growth, reasonably priced, reasonable forward PEs. They both pay healthy dividends. So they just tick so many boxes. And when you get that situation where there are few alternatives, I mean, we're not in a rampaging bull market here. There seems to be you tend to get a lot of crowding in these quality stocks. So you get a chance like out here, but there's nothing in these charts from a technical perspective to tell me that the momentum is waning on either of those. So definitely happy to hold at this stage. If you're a buyer, look, I think you try and buy dips. You don't get many dips on these, but I think you try and buy the dips on these if you're not in the stock, but definitely holding. These are definitely the type of bread and butter stocks we go for. We're not so big on sort of the top 20 or top 50 or so. We're more mid-cap stock pickers, and I don't know if you've noticed, but we've got a bull market by stealth in the mid-cap stocks, just punching up to 6,000 there, and the highest it's been since 2008. So you've got the broader ASX 200 nowhere near its highs from 2007, yet we've got the mid-caps punching through. So that tells you a lot about the current state of the market. It's a stock pickers market. It's not a bull market where you just buy anything and it goes well. So you definitely need the expertise to get out there and find stocks just like Hansen and Vita Group.
Fantastic. Well, Luke, there you go. Both our panel agreeing. Both our stocks are looking good. I particularly like Hansen as well. I can remember when Hansen was a small cap stock. It's now a mid cap stock, and it's been one of those stocks that you can hold pretty much forever. Although you can never say forever in this game, but it's certainly...
Buy with the intention to hold forever.
Indeed. Thank you, Andrew. Now, we'll move on to our next caller. We've got Nancy. Nancy is calling to ask about a stalwart of the market. Nancy, how can we help you?
Yes.
Nancy, are you there?
Yeah, I'm here. I'd like to speak about Sydney Airport.
Yes.
And Woolworths.
Sydney Airports and Woolworths. Okay, fantastic. Thank you, Nancy. Carl, I'll come back to you first on both these stocks. I mean, Sydney's been such a fantastic stock, and no real surprises for that, given the Aussie dollar going down and tourism sort of taking over so well. But where do you sit now with Sydney?
Look, I still like it. The momentum on the stock is very good. For the viewers maybe that haven't seen me before, I'm more of a technical analyst, I guess, than the fundamentals. Probably a 75-25 sort of split between technicals first and fundamentals second. The way I like to look at it is there's a lot of stocks out there, so I like to run my technical scans over the market. Yep. It reduces the 2,500 down to maybe 20 or 30 that then I go and have a closer look at the fundamentals on. I haven't researched the fundamentals on either of these stocks because they haven't been high up on the list, high up enough on the list for me to do so. So I'll simply comment on the technicals on each. Sydney Airport certainly looks the better of the two. What's interesting about these two particular stocks is that they're both probably considered to be defensive stocks, yet they've had very different outcomes over the last couple of years. So I think it's a good example for viewers in that you can't just say, oh, look, I'm going to play defence. And all defensive stocks are going to be the same because they can be very different. Sydney, no reason to sell that at this point in time. Definitely, I want to be a holder of that stock. Happy to buy it, I guess, also on the dips, probably back around that $7 mark. In terms of Woolworths, look, I haven't had to do research on Woolworths for many years now because it just hasn't been coming up on the filters. There is maybe a 10 to 15% chance, based upon the models here, that we have seen the worst of it. So there's an outside possibility that the bulk of the selling is behind us, and we may see some bottom fishing, some accumulation rather than distribution at this stage. It's a little bit too early to tell. I'd be more interested if I saw it maybe pull back a little bit to 22 and then see a nice rise again through those recent highs around 24, and that gives you the classic higher peaks and higher troughs, and only then could I start to do a little bit more research on it. So happy to hold Sydney or buy Sydney, but not ready yet to wade into Woolworths.
Okay, good. Now, Andrew, we might come back to you after the break on those two. Sure. I think there's a lot to talk about with Woolworths as well after those recent results.
Always is.
Yep. Always has been the last few years. There's no doubt about that. So we'll be back with more after the short break. If you'd like to speak with our expert panel, call us on 1300 30 34 35 or email us at yourmoney@skynews.com.au. Welcome back to Your Money, Your Call. We're still taking your calls, 1300 30 34 35, and emails, yourmoney@skynews.com.au. Now, before we go to the next call, we'll just go back to that last question. I think we had Sydney Airports and Woolworths. Carl's opinion was Sydney was the pick out of those two. What do you think, Andrew?
No, something's wrong with the universe, because I'm going to agree with Carl again. I think Sydney Airport is a wonderful business, and I don't think I'd be rushing to sell at this stage. I don't think I'd be an enthusiastic buyer either, though. It is a concern around the valuation there. I think really what's driven that has been that, speaking of interest rates, it's been falling interest rates that's made that so comparatively more attractive. And as I said at the start of the program, it probably is very much a case of lower for longer. But, it's just not that attractively priced at this stage. I mean, no rush to buy. Yep. With Woolies, the concern here is we got out of it over a year ago, and the real issue here is there's a lot of talk about masters and these other things, but for us, the lion's share of money is made in supermarkets, and supermarkets are losing market share, and they're under serious margin pressure. Yep. So you're looking at Woolies, which is well above its competitors, and certainly well above international standards. Yeah. So if those
with a margin near 8%.
8%.
Yeah.
So if that Coles around 5%, yep. and roughly speaking, I need to refresh my numbers, but roughly speaking, for every 1% decrease in operating margin, you see about 11% hit to the bottom line. It's very sensitive to that, just by the nature of the structure of the business. Yeah, absolutely. And high volumes, low margins. And so the concern is that how are they going to maintain growth and match those margins? It's going to be a very difficult trick to do. Again, Woolies will be around forever and a day. It's just a question of, have they gone through the worst of it? I don't think they have. We saw recently too that they're pulling back on some of their investment as well. They're going to be preserving more cash, and that's probably a good thing for the short term. But then there's some concern of, are you investing enough for the future?
Yeah. And Big W is still a real problem.
It's a real basket case there as well. It's very, very hard. So for me, there's just no great rush with Woolies at this stage. I'd frankly be a lot more tempted around the $15 mark. That seems a long way from where we are now. Yep. But that's the price I'd start to get very interested.
Okay, that's really interesting, Andrew. I mean, we just had a look at the margins of Aldi. I mean, Aldi and of course Lidl, which is now coming to Australia as well, is the big story. And the difficulty with those businesses is their cost bases are so much lower.
Yeah.
So it's likely they are just going to keep on taking market share until the point they get to saturation where people who don't like that format won't shop with them, no matter how cheap they are. Right. Yeah. But the really interesting thing I think with Aldi was that. We went back and had a look at what happened in the UK during the Great Recession, right? Our GFC. They call it the Great Recession in the US. I don't know what they call it in the UK.
I'm not sure either. I think we're the only ones that go with GFC.
They've got no idea in America what the GFC is. I was over there not that long ago.
It's a Roald Dahl book, maybe.
Yeah, that's right. But the interesting thing was they got a lot of market share during that downturn. Yeah. Aldi.
Yeah.
They really
people a lot more price sensitive.
Yeah, absolutely. So to me, that's long term also another threat to Woolworths and indeed to Wesfarmers.
Yep.
So
agreed.
Before we move on, I'll just say Sydney Airport's been one of our top stocks in the Financial Clarity portfolios for our clients over the last 3 or 4 years. We're still holding the stock. I took a little bit out around about 7.30, 7.35 a few months ago, but it's still an overweight stock for us because we think the tailwinds are there to keep this moving. And the numbers were just fantastic for the last financial year ended. They were between 15 to 20% increases from China, from the US, from Germany, and a couple of other of the major regions. So really good numbers there still. But they are getting expensive, and if things were to reverse in terms of interest rates moving back up, or all of a sudden there being a problem, say in China or something, then that's what I'd be looking for. But enough said about Sydney and Woolworths. We are now going to move on to our next caller. Our next caller is Mario. Mario, how can we help you tonight?
Hello. I'd just like to know if you think there's value in the following 2 stocks, Aconex and Vocus Communications.
Okay, ACX, Aconex, and Vocus, VOC. Carl, would you like to make a comment on either of those stocks?
Yeah, sure. I'll start with ACX. From a purely technical perspective, it's not one that I've been tracking, which is a shame. It actually looks quite good, so it's one that I regret hasn't come up on the scan for whatever reason. It's had a little bit of a pullback recently, though, just nullifying some of the momentum it's had of recent times. So, for 350 to 850 since February, which is a fantastic run if you've had it. Since then, I guess in the last couple of weeks, it's lost significant relative strength, we call it. Now, that is not relative strength, the RSI, which is one of those classic technical indicators. It's the relative strength comparative. So one of the key things I look for is how the stock is performing against the broader market. And the reason for that is I'm looking for what fund flows are doing. So stocks that are outperforming are obviously getting more of the fund flows than stocks that are underperforming. And, funds, especially here in Australia, tend to switch and, flip and flop. So
that's interesting you use that indicator because it's one that used to be used a long time ago by a lot of technical analysts many, many years ago. But I haven't heard recently of anyone using that.
I think the first that I know that it was mentioned in a freely available, publication was Stan Weinstein's The Secrets of Profiting in Bull and Bear Markets in 1988.
Yes.
That was published. And if you are a technical analyst, if you cut and you bleed and the colour of the blood is technical analysis, then you absolutely 100% need to read that book. That is
it's a great book, isn't it?
100% my favourite book on technical analysis. And
it's the only book I've read on technical analysis.
You know what?
Like
it's the only book I think you need to read. And he never wrote a sequel to that book. A lot of other authors of that time cashed in on some of their first book fame, but he didn't.
Just look for the man with the big buffy 80s
an amazing haircut.
And
he was asked, Stan, why did you not write a sequel to that book? Why did you cash in? He said, look, I put everything in the first book.
Yeah.
And I think he did. And definitely forms the basis of what I do. I've added a few extra things to it. But look, relative strength is important. If a stock is underperforming the market, it is not getting cheaper and cheaper. And in my opinion, it is becoming more and more dangerous because the funds are moving out of it and buying other things. So, look, I'll cut a long story short here and say that that's not my favourite pick right now. I think it's a great trend. I think if you're with it, stay with it. If you're not with it, then I think there might be a better buying opportunity a little bit down the track. On Vocus, very quickly, because I've taken up a bit of time here, look, I think it's time maybe to take some profits on Vocus. I know it's a brave thing to say because it is and has been such a great performer and it is a great company. But just looking at the momentum here, and again, that relative strength, the momentum is coming out of the stock, so I think it's time to get some money off the table there and seek other opportunities that are on the cusp of improving their relative strength.
Okay, good. Thanks, Carl. Andrew, do you like either of those two?
Yeah, I really like Aconex. I just think it's just an incredible business. It just ticks so many boxes, and the more I'm investing, the more I'm just gravitating towards these software as a service businesses, just because the economics are so nice. I mean, you've got to be careful with them because you can start getting carried away with some of your assumptions. But the fact is that they're incredibly high margin business, sticky customers, recurring cash flow. Again, all of these lovely themes. And you've got a really strong tailwind too, is that the rate of revenue growth and client acquisition and all the key metrics, client retention, customer acquisition costs, they're all moving in the right direction here. The trouble with Aconex, from our point of view, is that it's fairly juicy in terms of the price there. It's not cheap. So if I probably wouldn't be a buyer at this point in time. I desperately hope, no offence to shareholders, I hope it crashes, because I would be backing up the truck. More reasonable value. Yeah. Having said that, if you're really looking for a long-term holding, I think you can very easily overthink valuations on high-quality, fast-growing companies. Yeah. This thing looked expensive at the IPO. And now it's a lot more expensive. So again, you can overthink these kinds of things, but personally, I would wait for that one. Okay. What was the other company?
The other one was Vocus.
Oh, yes. yes.
So Vocus is out there swallowing everyone up.
Yeah, it's similar comments. Great business, a bit too expensive for me.
Okay, good. Yeah. Thank you for that, gentlemen. Now, we'll be back with more after the short break. If you'd like to speak with our expert panel, call us on 1300 30 34 35 or email yourmoney@skynews.com.au. Welcome back to the program. I'm Ken Bloomfield from Financial Clarity. Joining me on the panel tonight is Andrew Page from Motley and Carl Capolingua. I always have trouble with your surname. It's not that hard either. Capolingua.
Very good. Yeah.
Thank you. From Investor Systems. Now we will go. Oh, if you have a question you'd like answered, call us on 1300 30 34 35 or email yourmoney@skynews.com.au. Straight to our next caller. James, thanks for waiting on the line there for a while we were chatting away. How can we help you tonight?
Thank you for taking my call, gentlemen.
Pleasure.
I would like to know your views on what's going to happen to the share market in the near to medium term, and in particular, what's going to happen to A2 milk in the medium term.
Okay,
thank you.
Good, James. Thank you.
Thank you.
So, I mean, good question. I didn't ask for the crystal ball during the break there, but we should have brought that out and put it in the middle of the table. But it's always a hard one after such a good rise, guys. We've had a really good run, really from the end of February. It's been a very good recovery into the market, and it's broken through some of those, I guess, those technical sort of points that everyone was talking about at 5,450 and 5.5. What's your feeling as a technical analyst now with the market generally, Carl?
Look, the market is in a short to medium-term uptrend. We've seen those high peaks, high troughs on the ASX 200, but it's a very diverse market. So the ASX 200 is underperforming, say, the mid-caps and even the small caps as well. You've got pockets of strength in healthcare, absolutely amazing run there, obviously led by CSL Cochlear. You've had good performance in industrials, consumer discretionary, and then you've had poor performances in financial services and energy as well. So you can't just throw a blanket over it and say, what's the market going to do? It's a bit of a loaded question. The market's going to do what it's going to do is always the answer I give to that question, but there are going to be places that you want to be and places that you don't want to be. I can't see, incidentally, in the areas that I mentioned that are doing well, I can't see anything really in the technicals to tell me that those strong performances are going to change. So I don't think energy is going to all of a sudden be fantastic, nor will financials, but I think some of those other better sectors should maintain their trends. Having said all that, it's hard for me to get really enthusiastic and totally bullish, and I'm dyed in the wool bull. I've always been like to play the market from the bull side, and it's hard for me to get too bullish given what's going on a sort of a global macroeconomic view. I've got more concerns out there than I do have, things that are making me excited. So I think it's one where I like a high weighting in cash at the moment. But the cash you are applying to the market, again, it's not an ETF type of play. I don't think that's a wise way to go. I think you've got to go and pick stocks, and whether your methodology is value investing like Andrew, or it's technical trading like mine, you've got to have a methodology to do it. Because I think if you don't, this market is going to chew you up and spit you out.
And it's such a volatile market too, isn't it? I mean, really, if we go back in the market for the last couple of years, there's been no meaningful trend at all.
No, it's been tough.
Chopping all over the place, and a lot of it is because we've been getting our cues from overseas, coming out of the mining boom. I did detect a bit of a change in the market sentiment, in that first drop in May, the first drop in interest rates, because I don't think people really expected it until it happened. And, the inflation figure all caught us by surprise. And then everyone immediately assumed that there was going to be another drop in the coming months, which there has been. So there was no doubt there was a bit of a sentiment change. I certainly felt it at that point in time with the Aussie market. But I'm like you, Carl. I'm having trouble getting really excited about the macro environment. There's just a lot of risks out there, a lot of things that can go wrong, as well as a number of things that can obviously go right. But it's really important, isn't it, to know what you're thinking about and follow that through with a strategy in your portfolio, whether that be in which asset classes you're actually in, or indeed which sectors you're in. And it can make a massive difference, being in the right sectors.
I'll just say one thing, and I'll let you go, Andrew, but look, the money's still coming in. So, we've still got 9% of everybody's income goes into superannuation, 40% odd goes into the share market. So the money's still got to go in. It's got to go somewhere, but the active managers will be very careful with where they place it. You get that crowding, and it still gives you some great trends. So I'm not saying you don't want to be in the market. You do want to be in the market, but you've got to be very selective.
Andrew,
I'd agree with that.
You agree with that?
Yeah, I do.
Coming from a totally different perspective.
Yeah, it is. Well, I mean, I guess a general comment I would make, I would say whether we're doing this show tonight, 5 years ago, 5 years from now, we'll be saying, geez, it's uncertain and geez, it's volatile. That's the market. And I think a lot of people have good intentions, like James, and you're saying, well, I'm interested in the share market, but what's going to happen in the next little while? It's just really tough. So don't try and answer questions that are in many ways unanswerable. Look at it at an individual basis, So we've had a really great performance. The dividend service that we've run, we've topped the market by double-digit amounts over the last couple of years. We're very proud with that, but it's because we've been selective. We've avoided the companies that, ostensibly the big blue-chip businesses, and just focused on companies that have a really high level of quality and good valuations. And sometimes you'll go a long time before you find a good idea. Sometimes you'll have a whole 10 good ideas in a week, and you don't want to force it. This is a no-strike game. There's no one's holding a gun at your head. So wait until you've built some conviction around something, put some money into that, taking into account, of course, how you're weighted and all the rest of it, and go. And if you don't have a good idea, absolutely nothing wrong with sitting on your hands until one comes along. But the mistake that I think a lot of people make is they say, I'll wait for things to get better, then I'm going to invest. You'll be waiting forever. It's never going to be certain.
Or you miss the boat.
Or you miss the boat.
Because by the time everybody wants to invest, the market's already up 20%.
And I think there's a real psychological problem with that absolutism in terms of investing. I think that it's hard to, once you've missed a bit of a run in the market, it's hard then to go, fully into the market. And I think that
very hard.
You really need a plan. I say this to clients who come to see us. If you're doing it yourself, and most of our clients actually just get us to do it for them.
Sure.
Right? But if you're doing it yourself, you've got to write down your investment program, and you've got to know exactly what you're going to do pretty much before the circumstances come to you, and you have to react to them, because it's very hard in the heat of the moment to actually react if your emotions are involved and you haven't got a written plan. But anyway, we'll move on to Joe. Joe is calling from Sydney. Joe, how can we help you this evening? Hello, Joe, you there?
Yes, I am.
Oh, good. How can we help you this evening, Joe?
Yeah, hi, guys. Thanks for taking my call.
Pleasure.
It's just in regards to looking at a company called Silver Lake, SLR.
Yes, Silver Lake Resources,
And the other one is Brambles.
Brambles, okay. Two very different stocks there, Joe, but we'll have a go at them for you. Thank you very much.
Silver Lake, I don't know it very well. It's a gold miner. They've I guess, benefiting from what the price of gold is doing at the moment. But
we hope they are anyway, because gold has been screaming upwards.
I guess you got to.
They certainly look like they are there.
I won't give my usual mining answer. I'll just say this, is that what you want to do with these kinds of companies is you want to try, like all companies, is you want to try and go out and forecast what these earnings are going to be like 3, 5, 10 years out. Just generally, even if that's the best you can do, and then try and work out what price you'd pay for those earnings. Now, that's the approach that you take when you're investing. When it comes to these guys, what's the price of gold going to be like 6 months from now, 12 months from now, 2 years? I've got no idea. What's their cash burn rate going to be like in the meantime? What's the balance sheet like? Can they support it? So these are the things you've really got to understand. Don't make an investment in Silver Lake Resources because you've noticed that the price of gold is going up and the share price is going up. Make an investment in this company because you've got a very well-informed view of how these guys make money, what their assets are like, what their cash flows are likely to be, and then make a decision. I don't have those answers because I don't know the company, and frankly, I tend to put it in the too high basket. But I guess that's what I'd say on that. Brambles, I think, is a much, much higher quality company.
Pretty expensive these days.
My next words were, again, unfortunately, it's just driven to a point where I don't find it particularly compelling.
Certainly with world trade where it is at the moment. I mean, world trade has actually been tracking lower for the last couple of years. And I find it fascinating to see these comments on Bramble, what a fantastic quality business it is at a reasonable price. I think it's super expensive myself.
Yeah, I'm with you.
So what do you think, Carl, about both of these two? I mean, you're coming at it from a slightly different perspective, I guess, with the technicals on Silver Lake.
Yep. Yeah, look, I love a great chart, and Silver Lake's got a great chart, but I also like a great business, and Silver Lake's not a great business. Earnings are sporadic at best. So
if you're wanting quality gold companies, there's probably a lot of other.
And there are. And look, I've been plugging gold stocks for well over a year in the show. None of those which I've plugged at this point I would be getting into at this stage. I think they've all had a tremendous run and probably ahead of what maybe they're worth a little bit. I've got a new one,
right?
If you're interested.
Okay.
MOY, which is Millennium.
Okay.
And that is one of the rare small gold companies out there that is actually making some money. It has some good cash flows, great margins, is well run, and is 30 cents. So
where are their mines?
They're producing Nulla. Don't make me.
Nulla.
Yeah, it's in WA.
Whatever. WA somewhere. Okay.
But that would definitely be my pick in the gold sector, and it's a great chart and great company behind it. So either that or Metals X is another one I'm looking at the moment. So I think if you want to go into that mining space, in that speculative space, you can do a lot better than the ones that have already been pumped on hot copper. You need to get out there and do some research, and there are some good companies out there that they haven't run yet.
Excellent. Thank you, gentlemen. We'll move on to our next caller. We've got Victor, and Victor is calling from Melbourne. Victor, how can we help you this evening? Hello, Victor.
Yes, my question is NEC and...
NEC? Yeah. Yes.
And... And Medibank Private, please. It's a good time to buy or not?
Okay, good. Yeah, thanks for your question. So we've got Nine Entertainment and Medibank Private from Victor. Now, we had a bit of a downgrade there in the in that sector today, didn't we, with Seven?
Yeah.
I didn't get much of a look, actually, at the result, I've got to say, but I just heard the headline, and that was that outlook's very poor.
Yeah.
They've spent a lot on the Olympics. Didn't think that would be a surprise. I thought that maybe that they would have foreseen that, given that they were the winning bidder. But
presumably
anyway,
they're spending a lot to make a lot, you would hope.
You would certainly hope. But stock down 20% today. Not sure what happened to Nine today. It looks like it plummeted as well on the back of the Seven. But look, these are tough businesses to be in, aren't they? Free-to-air TV. It's getting sort of bitten at the edges from all different directions. And, it reminds me a little bit of maybe where Fairfax was 5, 6, 7 years ago. What do you think, Carl, about Nine?
Nine is a total basket case.
Total basket case. There you go. Thank you very much.
You want to avoid.
So avoid that one, I think, Victor.
Yeah, look, I forgot to talk about Brambles. If I had it, I'd hold it. If I didn't have it, I'd be waiting for a better price to buy it. Okay. NEC, I don't have anything good to say about this. I like positive trends. I like money coming into a stock because the smart money's done their research. There's no better alternative than this, and therefore demand is greater than supply, prices go up. It's the exact opposite of that, and therefore I would avoid it like the plague.
Okay, what do you think about Medibank Private?
Yep.
which has been a bit of a surprise packet, I'd say. It's a stock we've held since it floated because we felt like there would be a lot of cost out in that business over time. The other business I really like in that sector, which I've held for a number of years and still hold for my clients, is NIB. NIB is a smaller player, but I think they're very nimble and well managed. So that's my favourite in the sector. But we hold both of those stocks for clients at the moment. What do you think, Carl, with Medibank?
Look, Medibank's certainly better than Nine in that it's not plummeting, but it's lacking a little bit of momentum. So it's not knocking my socks off in terms of everybody's trying to be in this stock at this point in time. It's not terrible by any stretch of the imagination. It's just not one that's coming up on any of my systems at this point in time.
Okay. And Andrew?
Look, I think Nine Entertainment, look, 30 years ago, these are the businesses to own, right? I mean, it's just absolute rivers of gold from advertising revenue, virtual oligopoly type scenario here, very hard for new entrants to come in, just wonderful.
And Mr. Packer there at the helm as well 30 years ago.
There was a reason we had media moguls, there was just a phenomenal assets to own. But the world has changed and it's never going back to where it was. The content that we get these days, I mean, I have a lot of screen time, to use the common phrase, but I don't spend any time in front of the commercial networks because there's just nothing on. Yeah, it's pretty much that kind of stuff, and this, whatever you're into, I just think that the new technology out there, content on demand, the different models, I mean, these things are off to a very shaky start when we had the tech boom, Mark version 1, but these models are actually been worked out. They are absolutely decimating these other companies. Yeah. You could play the cigar butt type angle on these and try to be very clever with your valuation, maybe get one more puff out of it before it goes. And there is a value for Nine Entertainment, but it's one that it's just a very, very challenging business.
It's a risky play, though, isn't it?
It's super risky. Again, I think with investors...
And some of Australia's richest people have gone down with it.
Oh, absolutely. and perhaps they're a bit too close to it to sort of see what's going on there. And I would... the thing I would remind investors is that really, for my money, I think once you get beyond 20 stocks in a portfolio, it's just diversification. It's not really doing you any favours in terms of risk reduction. And so really, what you're trying to do is say, what's the best 20 investments that's out there? And Nine is nowhere near that top 20. Yeah. So if you're holding, and generally speaking, and I'm guessing here, but people call up and ask about companies in this scenario because they've probably held it for a while and they're suffering and they're hurting and they want to know. And I think it's understandable, but the trouble is that decision to sell is very heavily influenced by them anchoring on their purchase price.
Yeah, that's right.
And this is going to sound very harsh, but the market doesn't care or even know about your purchase price. No. And
that's only your psychology.
It's your personal experience, and it's a nasty experience. And I don't care if you're Warren Buffett or Peter Lynch, you're going to have those experiences. Yeah. But what those really successful investors do is that when they realise that they got it wrong, and we all get it wrong, is you get out. It's painful, but that money, you might have had $1 million in there, and now it's worth $100,000. That $100,000 can be put to much better use elsewhere. And you get a tax loss as well, so it's not all bad news.
Yeah, that'd be a nice tax loss to have.
Very good tax loss. Bit of a silver lining. Medibank is a much, much better business. I'm with you, Ken. I like NIB better. Okay. Again, I'm saying this a lot, but just not the most attractive valuations.
Okay, good. Now, we're taking a short break now. We'll be back to answer more of your questions in just a moment. If you'd like to speak with our expert panel, 1300 30 34 35 or yourmoney@skynews.com.au. Welcome back to the show. If you have a question you'd like answered, pick up the phone, give us a call on 1300 30 34 35, or if you prefer, email yourmoney@skynews.com.au. Go straight to Andrew. Andrew is calling from Melbourne. How can we help you tonight, Andrew?
Good evening, gents. I have a question for great Andrew Page.
Andrew for Andrew, okay.
Okay. Just at the current market conditions, which sector he likes, and within that sector, which stocks he likes, please. Simple.
Okay. Yep, very simple, Andrew. Now, that's a really simple answer there, Andrew, and we'll check this out in 6 months. We'll write it all down, okay?
Give me 2 years. Give me at least 2 years. Listen, I don't actually approach the market too much from a sector perspective, what they call a top-down. Yeah. And that's where you sort of look at, what industries are doing best and then try and pick the best company within that. I'm more of a bottom-up investor, so we're looking at individual qualities of business, and obviously the wider industry dynamic plays into that, but I'm not starting at the sector level. Yeah. So when we look at the recommendations that we've made over the last couple of years, there's really no theme that emerges there in terms of an industry type. There's definitely, Carl mentioned earlier that he's finding a lot of success in the mid-cap space. I would echo that. I think this chase for yield has meant that most of the value lies in that space. So if there's a theme around where I'm looking, it's probably in that space. I'm restricted to give too many of our recommendations away. There's paying members sort of behind that, but there's a couple that I think are really interesting businesses at this point in time. I think Washington H. Soul Pattinson's a really nice, diversified mini Berkshire type company. Great management, good stable of assets, good yield. I think that's a really lovely bottom drawer type stock. And if you want something with a little bit more growth on it, I'm still a fan of IPH. These guys do IP law, patent protections, that kind of thing. They're growing very well. They've got a huge growth engine in their Asian operations. It's a business I quite like. It had a very big run-up. Things got crazy. The market realised the error of its ways. It pulled back, and now it's at a point where I think it's quite attractive.
Excellent. Good. Thank you, Andrew. Now, I know enough about Stan Weinstein to know that he's a big man on sectors. Yeah. He likes the sectors that are performing, as you were saying before, the stocks that are performing better than or relative to the index generally, but he also likes the sectors that are performing better than the index. Yeah, look, I mean, Stan was around when, computers had, 128 kilobytes worth of memory. So it made a lot of sense. And that was if you were in a really modern office. Yeah, well, absolutely. I mean, absolutely. Look, in 1988, I had a Commodore 64.
Me too.
So it had 64 kilobytes of memory. So it made a lot of sense in those times to be top-down because there were a lot of stocks and it took a lot of time to look at all those stocks. So if you started from the top, you said, look, given what's going on in the world right now, which sectors are likely to fare best? It's this sector here. Well, that cuts it down by 90%, and I'll start looking here. In these days, I've got this wonderful i7 chip thing that clocks 3.84 billion gigahertz per second, and I can get through all of the stocks on the ASX and all of the stocks in the USA in about 45 seconds. And so you don't need to be top-down, you can be bottom-up. I'm absolutely 100% with Andrew there. I'm a bottom-up investor, which means I look for stocks. I want to find a nice chart, and behind that chart, a nice business. It's just, I don't think there was a question there from Andrew for me, but that's more of a philosophical, my philosophy. Okay, and any particular stocks, couple of stocks for Andrew to maybe have a look at? It's pretty slim pickings at the moment. We've got about 13 stocks on our watch list, our hit list at the moment. Many of them we're obviously invested in. So when I say a stock here, it's we be aware that we probably hold this stock. Data 3 is probably one of my favourites at the moment. It's very much in that software space, cloud solutions as well. Double-digit earnings growth is a must for me. I pretty much won't buy a stock unless it's growing its earnings by double digits, which is gold in this market because, again, that crowding effect, everybody wants that too. The best investors want that, and that makes stocks go up. It's reasonably priced. That's the other thing. There's no point having something that's growing at 30% per annum if it's trading at 200 times earnings. Because somebody's already picked that opportunity out. So okay, well, you've given a few pieces of gold there tonight. So thank you for that. Now we will go to a short break. We'll be back with more of your calls in just a moment. Welcome back to the program. Joining me on the panel tonight is Andrew Page from Motley and Carl Capolingua from Investor Systems. Our lines are still open. If you have a question you'd like answered, call us on 1300 30 34 35 or email yourmoney@skynews.com.au. We'll go to Brian. Brian, thanks for waiting patiently on the line there. How can we help you tonight?
Oh,
thanks for taking my call. Love the show.
Great.
Just the panel's view on just a couple of stocks. One is Select Harvests, SHV's the code. Yep. And the other one I'd like to get an opinion on is Mantra, MTR. If they could help me with those two.
No problems. Thank you, Brian. Might go to you on this one first, Andrew.
Yeah, both very interesting companies. Yep. Select Harvest had a very good run recently from the business and from the share price, in the sense that there was a real problem with the Californian almond production. So these guys grow almonds. And they just cleaned up on that. Yeah. So there's big droughts over in California and the rest of it.
Summer before last, wasn't it?
It might have been then, yeah.
I think so, yeah.
Now, I think that situation has rectified itself to some degree, but I think it's an agricultural company, so let's take a step back here. The first thing you've got to understand is that, yields can change and commodity prices can change and the rest of it, so it is tough. One of the things to particularly look for Select Harvest is that these are very, very thirsty plants. They require a lot of water, and that means that they require a lot of water rights, and there's a lot of uncertainty for me around that point of time. So I started digging into it, thinking it was a really interesting thesis, and just got to a point where it was beyond my abilities to start forecasting. So again, I put that in the too hard basket, but I absolutely understand why Brian's interested in it. I think if you've got a particular insight into that industry, it gives you a real edge. So I'd encourage people to look further there if they've got that. It's not me, unfortunately. Mantra Group, I'm a fan of. I think it's a good business. These guys do all the accommodation, resorts, those kinds of things. So this is, when you hear people talk about Mantra, it's really a play, if I can use that term, on the tourism boom that we're expecting from Asia and China in particular. Yeah. And they'll likely do very well as a result of that. They're also a pretty capital light model as well, so they don't own the properties as well, which means that their dollar goes a lot further in what they need to run their business. So I think it is a very, very interesting business, and I like it.
Yeah, okay, good. Carl, either of those two that you like?
Yeah, look, I definitely like Select Harvest. It's more of a turnaround play. So, there's imagine a chart, there's two general types of charts you're going to have. There's one that's bottom left, top right, that I'm interested in, and one that's a bit more of a U-shape or a V-shape. Both of them obviously towards the right-hand side heading up. This is the latter, so it's more of what I call a turnaround play. So straight away the risks are increased compared to something that's in a nice trend. Having said that, it meets all the criteria for our main system. It flagged a buy about a week ago because of its recent strong performance. It's doing well against the broader market. In terms of the overall trend, it is obviously short, medium term, and now just becoming a long-term uptrend. That's why it's flagged a buy signal. In terms of the efficiency of the trend, it's quite good. So on its up days, it does well. On its down days, it doesn't do that poorly at all either. So you get,
which means the buyers are working the stock hard on
they're sticky buyers. They're sitting on the bid on the bad days for the market where everybody's selling other stocks. That latent demand of the system is soaking up supply, and you don't get that downward price movement. So that's pretty important. So it's a bit more of a higher risk buy for me. I prefer to be buying it with a little bit of momentum through $8. I wouldn't just run out and just buy it here. I'd actually like to see it pushing through that $8 level, because that's a bit of a key level at this point in time. Mantra, I'm less enthusiastic on. It's I'm always about right stock at the right time. I just don't think it's the right time on that one just yet. It's kind of the opposite type of chart to Select, where you've got these really steady, you can see on the chart there on screen, lower long-term peaks, long-term troughs. And I would prefer to just stay away from that one at this point in time. So, look, if I had it, I'd want to be out of it, because I don't think this is going to be the best stock over the next 12 months. And I want to chase that best stock over the next 12 months. So if I had it, I'd get out right now and go and look at one of those better stocks. If I didn't have it, I'd avoid it.
Okay, good, and we've finally got you guys disagreeing, which we've been working on all night. Thank you for that.
Just a matter of time.
Now, in terms of the Mantra Group, it's interesting. I think that whole sector, the inbound tourism sector, certainly been a sector that's done well the last few years. Another stock that we quite like, we've still got a small holding in, we've been in for a couple of years, is SeaLink. SeaLink's basically a ferry group. They're in a mixture of tourism and also just transport for the ferry for ferries up in Queensland now. They bought out a company about 18 months ago for that, so that's one that you might be interested in as well. But we'll go on to our next caller, We have Simon. Simon's calling from Sydney. Simon's got a great sounding business to ask a question about. Looking at the screen there. How can we help you, Simon? Yeah.
Yeah, hi, gentlemen. Have you heard of Fast Brick Robotics, SBR?
I haven't heard of it, but it just sounds fantastic.
Yeah, they've been newly listed. They've had some announcements recently, which I haven't really read into, but spiked up a bit. But the other stock is Isentia Group, ISD.
Yes.
Bought into that recently as well. I hear it's a good company, but price has come down a fair bit over the last 9 to 12 months. Any insight in those two companies would be great. Thank you very much.
Great. Thanks, Simon. Thanks for your question. Now, Andrew, FBR, Fast Brick Robotics.
Yeah,
That's exciting.
These guys, as the name suggests, it's a robotic bricklayer. Yeah, and look, I don't know much about the business. It's not one that I would invest in at this stage, though. It is, generally speaking, when you're looking at these kinds of companies, they've got a pretty cool product, and I've seen a video on it. It's very cool, but we're yet to see any good evidence that this is taking off. And until we get to that stage, I would, unless you're just after an out-and-out punt, I would be tempted to wait, even if that means missing out on some of those early gains if they ever eventuate. Statistics are against you here. Most companies in this scenario never really make it to that stage. Again, that's not to be critical. The market is there to raise capital so these guys can pursue their business goals, and business is hard, and particularly when you're trying to, disrupt a space like this. So I think it is an interesting business. I can see why Simon's interested in it, but at this stage it's extraordinarily speculative. So I'd be looking at, how, things like, how much cash have they got, how quickly are they burning through that, what are their sales like, how many sales do they need to break even, how far away is that going to be, these kinds of things, and then you've got a sense of when it's an appropriate time.
Cash burn's a really important one, isn't it, for these startups? So
Yeah.
you need to know that if they keep on burning cash at the rate they have been for the last 6 months, how long are they going to be going back to the market?
Look at almost any mining company on the market. They've been around for a long, long time. They've always lost money. I mean, how do you balance that equation? Every few years they pass the hat around to shareholders and they ask for more money. It's what they have to do. It's either debt or equity, right, that you're going to need. And if you've got not much cash left and you're burning through it very quickly, you're going to probably have trouble borrowing the money, so it's going to be back to shareholders. And the trouble is that even if they eventually make it, you've been diluted so substantially along the way that your returns are pretty small. So just bear all that in mind. Isentia is a much better quality business. So these guys it's a media monitoring company, as I understand it. So they'll track mentions of your company or yourself if you're a high-profile person in the media, and they give you a lot of good intelligence on that kind of stuff. It tends to be one of those things that, as I understand it, is fairly regarded as a fairly essential thing for their customers. They've got pretty high customer retention rates and the rest of it. And I'm no expert on the business, but my understanding is that they've got a pretty neat piece of kit there, some really nice software that helps them do what they do and gives them a bit of an edge on their competitors. I think it's definitely the pick of the two.
Okay, good. Thank you, Andrew. So that's from a fundamental perspective. Do your homework on any startup.
Absolutely.
Sounds like
on any company, full stop, but especially a startup.
Especially a startup.
Definitely.
Yeah, to look at those, how long it's going to take them to bring the product to market, and of course, how long is a piece of string? It's very hard to know that anyway, isn't it?
Yep.
Carl, do you like either of those businesses?
Look, on Fast Brick, the chart's fairly reflective of what Andrew said. Sideways to up. If you really squint, maybe there's a bit of an uptrend. Maybe there's a bit of accumulation coming into it. Look, it could be a 100-bagger for all I know, but right now it's not something that the system is saying it wants to participate in.
It looks very thinly traded.
It is thinly traded. It's very choppy. It's just not meeting the criteria. So it might be the best stock in 10 years' time. I might regret this decision to say I won't be investing in this anytime soon. And
so that's a Randwick alternative, is it?
Well, no,
go down to Randwick
look, if you are going to punt, and I don't mind having a punt. Whether it's 10% of your portfolio or 5% or whatever it is, right? I've got no problem with it. So I'm not one of those, fuddy-duddy people that get up on this show and say never buy anything that's speculative. And I'm the opposite. If it's going up, I want to own it. So this isn't going up though. So I think in the speculative space, there's better opportunities out there. And your biggest enemy, as you guys are saying, is not whether the product is taken up. Your biggest enemy is just the fact you don't make any money and you've got costs. and eventually you're going to get diluted. It's the oldest story. I'm from Perth, right? So I've owned about 10 billion mining stocks where I've been diluted over the years. So look, it's a pass for me. ISD, it's a funny one. You look at the business and all the numbers check out. I think it probably got a bit expensive for someone. It's got great growth, but it got a bit expensive. And then one of the funds said, hey, you know what, we've made some good money on this one. Let's get out. And their selling was a bit more than the other people's buying, and you get this loss of momentum. And I just don't think you want to be in the stock until it shows the momentum that it's back to a level which is looking attractive to the big money again, and then they start to pile back into it. So that's a pass for me as well.
Okay, well, there you go. I think both our guests tonight are not rushing into either of those stocks at the moment, although Andrew quite likes it fundamentally, I sent you. We now have another caller. We've got Elizabeth. Elizabeth is calling from New South Wales. How can we help you tonight, Elizabeth?
Yes, look, I'm just wanting to know your opinion on Estia Health.
Estia Health, okay.
Yes, I got a bit of an idea of where you think it might be going and whether to hold it or not. Okay,
and Elizabeth, were you in the stock at the float?
No.
No, okay, good. Thank you very much for that question. This is an interesting sector, isn't it? It was the darling sector of the market for a couple of years there.
Yeah.
We actually took some of this float for our clients, Estia. We exited the stock, I'd say, about 15 to 18 months ago. I got involved in a US healthcare business and got some real insight into that. That helped me look at the Australian perspective, and at that point in time, at the level that these stocks were in Australia, trading on PEs up in the high, mid to high 20s, we just thought they were way too expensive. Now, but these stocks long term are providing a service for the ageing population in Australia, and they should do reasonably well over the long term. What's your view at the moment there, Carl? Looks pretty ugly, the actual downtrend there still.
I think I'm going to be a little bit predictable here on that chart and say that it's not one for me. It's definitely not coming up on the models as a buy. It's not the worst one I've seen. You look at some of the dynamics within the trend. So it tends to rise. It's a funny one. It tends to rise during a trading session more often than it doesn't. The falls are coming from large, sharp, concentrated falls.
Right.
Otherwise, it's actually not so bad. So
there might be some very,
it's being supported.
Very
It's being picked up by somebody. It's just way too early for me to tell whether it's the start of something fantastic or it's just ebb and flow of the market. So I'm definitely staying on the sidelines.
Yeah, there's a lot of concern, I think, with this model now as to what's going to happen with the government and with Medicare, and how much they're going to squeeze back out, because these guys seem like they got away with a fair bit for quite a while, and it's being tightened up on.
I think this whole sector is an accident waiting to happen. Right. Frankly, there is this story around them that we have this ageing population and that we're going to need a lot more of these residential aged care homes, and the industry as a whole will get much larger in the future. And I actually agree with all of that. But the trouble is with these businesses is that if you look at individual aged care centres, they're awful businesses. There's no growth in it. Unless you can increase the occupancy, meaningfully reduce your costs, and there's not a lot you can do there. I know not many people are going to want their elderly parents crammed 10 to a room, or you increase prices.
Or increase turnover, which is very nasty.
Which is another way of potentially doing it.
Yeah.
So the way that these businesses make money is they're doing the roll-up strategy. So they're aggregating and aggregating and aggregating, and that can work very well. We've seen it work very well. We've also seen it work very, very badly. And I think we could spend a lot of time on this, but very quickly, I think the problem here is that they're doing a little bit of voodoo financials here in terms of the return on capital employed equations that they're using here. They're including these refundable accommodation deposits. They're treating it like operating cash flow, and they're using that to then leverage into more stuff, and they're getting the RADs from there, and they're leveraging into that kind of stuff. Now, that's fine if everything continues to go well, but if there's the smallest hiccup there, I think shareholders are in for a bit of a rude shock. There's very big regulatory pressure. I mean, I'm going to make this up, but it's something in the vicinity of 70-80% of their money comes from the government.
Yeah, that's correct. And it's over 70%.
And the government, we've seen this with primary healthcare and a lot of other. They're really struggling on that front there, and it's going to be difficult for them to get even more money out of that.
Well, it certainly is. With an ageing population, of course, the government's under pressure anyway. The government balance sheet to keep on funding increases in healthcare.
Yeah.
And, if we look at those increases, they're looking like, well, if you look at the last 10 years, healthcare increases in the budget have been between 4 and 6% per annum.
Yep.
They've got to do something about it, or they've got to raise money somewhere else. And, of course, we saw in the last election, it's pretty hard to cut healthcare, isn't it?
It is. And the other trouble is as well, it's one of those sectors where these aren't the only guys prosecuting this strategy. There's others of them out there. And so when you've got these all these players rolling up...
large players.
Yeah, and they're all doing the same thing. They're all looking at the same assets. And when you've got a lot of hungry bidders with a lot of easy money trying to buy the... Prices get higher and higher, which therefore means your return on investment gets lower and lower. The actual individual assets aren't attractive at all. There's big regulatory issues. While all of those big longer-term themes are true, I don't think that supports the case. We could have said 100 years ago that airline travel's going to go through the roof. Everyone's going to be flying on planes, and we'd be right. But it was a terrible industry. Same with automobiles. Same with a whole bunch of things. So, and we see it come up on the show all the time. People will say, lithium. The world's short of lithium. Get into lithium, or graphene. We need that. And there's truth to all of that, but it doesn't mean that the individual players and in particular shareholders would do well. Yeah. So for me, Estia is a clear no.
Okay, good. Thank you. That's very definitive, gentlemen.
Watch it double tomorrow now that I've said
I asked you about Estia already, didn't I? So that's a no already.
Yeah, now pass me.
Okay, we're taking a short break, but we'll be back to answer more of your questions in just a moment. Welcome back to the program. If you have a question about a stock or shares, our phone lines are still open, 1300 30 34 35, or email yourmoney@skynews.com.au. We'll go straight to Charlie. Charlie's calling from Melbourne. What's your question tonight, Charlie?
Oh, thanks. My question is FIR.
FAR, yes.
Yes, and VRC.
VRC.
What do you think about the shares, if I should keep them? Because they tell me they find a lot of oil, West Australian.
Yes.
And they jumped to 15 cents, but now they just keep going down. I don't know why.
Okay, so FAR and VRC. Good, thank you, Charlie. We'll go, I think, probably to you on this one, I think, Carl, in terms of the technicals, because they're pretty small companies, I think, those two.
Look, FAR doesn't make any money. Now, this stock has been...
So stay far away?
It's been around for a hell of a long time, and, I've followed it on and off over the years. And, it's had its moments, but it's been around for so long and it's still not making any money. What does that tell you?
I bet you the share count's gone up.
Well, I'm sure there's a few more shares in issue today.
Number of shares issued.
Look, I'm all about track record. The technical analysis is the study of track record. And it doesn't look like the track record from a business perspective is very good here, and the chart simply reflects that. The charts and the business, the quality of the business, they do come together, I believe, and I would definitely not be putting my money or my clients' money on FAR.
This is in the oil sector, is it? Or?
It is, yeah. It's an energy oil and gas producer. I think they do have some production, but they still can't make money out of it, which is a real concern. So, look, apologies. I know everybody wants to call up and hear the panellists gush about their share and tell them how wonderful it is, but, this is not the best stock out there, and I would not own it. The other one is VRC. And I must admit, I haven't heard about that one. Look, it looks better than the other one. In that the trend is far more prominently up. However, over the last few months, it has taken a pretty significant turn for the worse. And I think it's lost enough momentum for me to say that it could take months and months and months of waiting before this starts to show any signs that it's going to go back up. So I think the smart money that knew about this before you knew about it is well out of it by now, and it's just you holding on. I'm sorry to say that. And I think there's better things you can do with this money as well.
Okay, thank you, Carl. Andrew, I probably won't even go to you on this one.
Sell.
So, okay, next. Okay. Now, and I guess the other thing with both these stocks, if they're both in the oil and gas sector, it's they're not getting any free kicks out of the oil price either.
Absolutely not.
Yeah. Now, we've got an email to go to. Carly asks, I've jumped from A2 milk. I'm very happy with the profit and expecting a step back as people consolidate in the name. Would the panel buy Blackmores, BKL, at $150 or some CBA for dividend growth and safety? Okay, well, we talked about CBA for dividend and also for safety earlier. We were talking about the banks generally, and I've got to say that I was pretty disappointed with CBA's last result. I thought it was very poor quality. I thought they were chasing business at the margin, that they were making, probably no more than 100 basis points or 1%, 1.1, 1.2% out of in both commercial property and other infrastructure deals. And if you're only making a margin of 1% on that type of riskier business, then I really think you've lost the plot, quite frankly. So, to my mind, CBA actually is very expensive. And if you compare them to banks overseas and what's happened to banks overseas over the last 7 or 8 years, and if the same thing happened to Australia, CBA would be a lot lower in share price. That's just my 2 cents worth. I think there's some other better banks out there, but all of them are chasing margin, as we say. All of them are having margin pressure, and it's really a matter of how long can they keep their dividend going, in my opinion. They are going to have to cut it at some stage, in my opinion, having a close look at the numbers. It's just a matter of how long you can keep on getting that dividend for. Now, I've just hogged that question. I'm sorry, guys.
I couldn't have said it better. I agree with you.
What do you think about BKL, either of you?
Yeah, I like Blackmores. Well, I don't like their products. I think, frankly, there's virtually no evidence behind any of them to substantiate their health claims. Certainly there are exceptions to that, things like folate, but in a lot of cases you're really just paying expensive money to colour your urine, if I'm going to be crass about it. But I've got to put that aside. Because the fact of the matter is people love it and they are selling a hell of a lot more. Now, Blackmores, like A2 Milk, like Bellamy's, is all about China. So about 50% of their sales are derived from there. A good whack of that comes from the Daigou, so the Australian-based shoppers who send it back. So really strong balance sheet. I think they're virtually debt-free at this point in time. They've got a lot of good capacity in their manufacturing. They've got a really rock-solid brand name, very well regarded. They've made a couple of very, I think, smart acquisitions that they'll be able to leverage off. I really like the business and I like its opportunity. And they pay out about 3/4 of their profit to shareholders in the form of dividends. So the yield is low because of that rising share price. But on a forward basis, it's not too bad. I mean, there's nothing wrong with a yield of about 2.8% in the world that we live in today, especially when you've got franking credits attached to that, and especially when that dividend is growing very, very, very strongly. So I do like the business.
Okay, thank you, Andrew. Now, very quick one, Carl, on Blackmores.
No for me on Blackmores. And I share the same concerns. Surely the Emperor's going to realise he's not leaving the clothes pretty soon. Bellamy's would be my pick in that sector, although there are 13 stocks ahead of Bellamy's that I'd like. Just on the banks, people love banks in Australia because of their fantastic dividends, but there are so many better businesses out there with even better dividends. I could reel them off or go to the website.
Now, if people want to go to your website...
Or join Dividend Investor.
Can you just give us quickly what your website is if people want to go and have a look at some of your research?
Very simple, www.investorsystems.com.
Fantastic. And Andrew, I know Motley Fool's really well known out there, but...
Well, it's hard to avoid us. If you've typed us into a search engine, we've probably sent you an email or two. But yeah, so Dividend Investor is a service I run. We're all about dividend-paying stocks. We don't have a single bank on there as well. But we've got a lot of companies that we think have sort of been under the radar. Companies, strong balance sheets, good reliable earnings, good yields. We've been very happy with it, and we think there's a lot of opportunities outside of that very crowded top 20, top 50 space.
Fantastic. That's all we have time for today. Thanks so much to our guests, Andrew Page from Motley Fool and Carl Capolingua. I finally got it, Carl, from Investor Systems. And to you, our viewers, for all your calls and your emails. Until next time, I'm Ken Bloomfield from Financial Clarity. Thanks for your company.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.